Well, in order to understand the ledger, we need to understand that originally the business transactions are recorded in the subsidiary books. In our earlier classes, we have seen what a subsidiary book is. What are the various subsidiary books? The subsidiary books are the purchase book or the purchase returns book, the sales book, the sales returns book, the receivables, bills receivables book or accounts receivable book, accounts payable book. So these are all my subsidiary books. Or if no transaction, if a transaction doesn't find any place here, what we do is we record the transaction in the journal proper. So the first place of recording any business transaction would be in the books of original entry, which is the subsidiary book or the journal proper. So the ledger cannot be prepared without these books. In the other words, we would say that the ledger is prepared only after we make the journal entries. Which means the ledger cannot be prepared without the journal or the subsidiary books, right? Why is it required? The ledger accounts are required to be made so that we have a detailed and organized record of a financial transaction. We'll see how. Now comes the question as to how many ledger accounts are required to be prepared by a company. The answer to this would be it depends upon the nature or size of that organization or a business. The smaller the organization, the lesser would be the number of ledger accounts, which means the number of ledger accounts to be prepared depends upon the number of accounts or number of business transactions that you need to enter. Now the question comes as to what a ledger account is. The ledger account is a place where the transactions of similar nature, which are related either to a person or an asset or a liability or an income or expense, is recorded in a summarized and classified form. Now what does that mean? We have seen in our earlier lectures that the whole world of accounting can be divided into these five classes. This would be either the accounts related to persons, assets, liabilities, income or expense. In other words, whatever the transactions are can be classified into these five parts. And ledger is a place where all the accounts or the transactions related to these accounts are recorded in a summarized and classified form. What does this mean? It means if I'm talking about a cash account or a cash ledger, I would be recording only the transactions related to cash. There won't be any credit transactions which would be recorded or posted here. Similarly, if I am talking about a land account, all the transactions related to land would be recorded in the land ledger or land account. Similarly, plant, building, machinery, all these accounts, all the transactions related to that specific account, be it related to a person, asset, liability, income or expense, the place where they are recorded in a summarized and classified form is called as a ledger account. Now we need to understand that the ledger account is also called as the principal book of accounts because it is a place from where the final transactions or the final entries are made. What are these? These are the financial statements, which means from ledger, the balance in the ledger account would help me in preparing the profit and loss account, would help me in preparing the balance sheet. It would also help to prepare the cash flow statement. So this is ledger account is also called as the principal book of accounts, right? Talking about the format of a ledger account. The ledger account is very simple. You have two sides. The left hand side represents the debit transactions. The right hand side represents the credit transactions. You have four columns on the left hand side and four columns on the right hand side, namely the date, particulars, journal folio and the amount. Date means the date of transaction, particulars means the nature of the transaction, which account is to be debited or which account is to be credited. Journal folio means the page number of the journal or the journal book. Amount would be the amount. The same things is to be repeated on the right hand side also, which is the credit side. Now if I talk about the cash account or cash ledger, this means I am supposed to record the transactions related to cash only. This would be giving me a summary of the cash transactions which have happened during the accounting period. Right? The format of ledger account is very simple. On the left hand side you have 4 columns. On right hand side you have 4 columns. The left hand side represents the debit side and right hand side would represent the credit side. And these would be same in all the ledger accounts. There won't be any change. Right? By way of an illustration, let's try understanding how to prepare the ledger account. Say for example, it says that these are the transactions which are given to us. Just a minute. Yeah. These are the transactions related to the credit purchase made by an organization. Now we know that whenever we purchase, the journal entry would be purchases account debit to the party from whom I have purchased. So here I would say sundry party, sundries. The sundries means the name of all these 5 clients. Roy and Company, Sen and Company, Carmaker and Company, Mandal and Company, Naskar and Company. So the entry would be one account to be debited and the person or the parties from whom we have purchased, we need to credit these, right? So if you remember the journal entries, we would come to know that in order to have these 5 transactions, you need to have 5 ledger accounts and 1 ledger account related to purchases, which means this transaction would require 6 ledger accounts in all. Let's see how. If you look at the various ledgers, this is the journal entry that I was talking of. What we do is we debit the purchases account and then we credit all the persons who have supplied material to us. Since it is a credit purchase, we write the name of the parties. Had it been a case of cash purchase, what I would say purchases account debit to cash. But since it's a credit purchase, what I do is I write the name of all the parties on the credit side. These are all credit transactions. And this is a debit transaction. Right? So we have how many accounts do we have? 1, 2, 3, 4, 5 and 6. The first account is here the purchases, second account would be Roy and Company account, third would be Sen and Company account, fourth would be Carmaker and Company, fifth would be Mandal and Company and sixth would be Naskar and Company. Clear? So the number of ledger accounts to be prepared would depend upon the number of transactions or number of persons who are involved in this particular transaction. In the example given to us, we have 6 accounts in all or 6 ledger accounts are required to be prepared. Now if you look at the purchase account, we know that purchase account is always debited. So on the debit side of the purchase account, left side represents the debit side. On the debit side of the purchase account, what I say to sundries. And the total of all this would be recorded on the debit side in the amount column. Similarly, we need to credit all the persons who have supplied goods to us on credit. So if you look at all the accounts, Roy and Company, this is credited, recorded on the credit side. Sen and Company, recorded on the credit side. Mandal and Company, recorded on the credit side. Carmaker and Company, recorded on the credit side. Naskar and Company, recorded on the credit side. So the amount of Roy and Company, the account of Roy and Company would be credited by 20,000. Here it is. Sen and Company would be created by 30,000. This would be Carmaker would be created by 15,000. Here it is. Mandal and Company 60,000. Naskar and Company 35,000. So these would be recorded on the credit side of the person who have supplied goods to us. And the debit of that all the accounts would be transferred to the purchase account. Why? Because our journal entry is purchases account debited to all the parties. So from journal entries, you need to prepare the ledger accounts, or you need to post that into the various accounts of different parties. Hope this is clear. Again, looking at the other example, say for example, if I say cash account. Now let's see how these accounts would be talking about the summarized way of this, right? So if I look at this cash account, it would tell me cash account is an asset account. If you remember our earlier class related to the rules of debit and credit, on the debit side of cash account, you record all the receipts, cash received. On the credit side of this, you record all the cash payments. So we say it is a summarized form of any account, right? So on the left side, if we say on the cash account, on the left side, you find all these accounts from where the cash has been received. You have received cash due to capital 40,000. We have received from RAM 10,000. We have received from bank account 30,000. We received from selling the goods 20,000. We have received the commission of 5,000. So in all, I have received an amount of 1,05,000. On the right hand side, if I see the payment side, I say that due to rent, I have paid 3,000. Due to salary expenses, I have paid 10,000. I have purchased some goods worth 6,000 rupees. My electricity expense were 4,000. My conveyance charges were 2,000. Which means on the right side, what I do, I record the payments. So I would say cash account or the ledger of cash account is a place where I get a summarized form. Summary of all the cash receipts and cash paid. In other words, I would say I have received 1,05,000, of which I paid this much of money, 10 plus 3 13 plus 6 19 plus 4 23 and 2 25. So out of 1,05,000 I have paid 25,000, which means I am left with 80,000 of cash in my balance. This amount would be shown in the balance sheet under the head assets, because cash for any business is an asset. So this is the reason why we say that ledger account is nothing but a summary of transactions related to a particular account. So when we talk about a cash account, we come to know that all the transactions related to cash during a period, starting from 1st of April ending on 31st of March, this would give you how much cash has been received and how much cash has been paid by the business during a particular accounting year or accounting period. Is this clear? Similarly, if we talk about the rent account, we come to know that whatever rent we have paid during a particular period would be recorded in the ledger account related to rent. So this is a ledger account related to rent, and suppose you have started paying the rent from November onwards. On 1st November paid 20,000, 1st December 20, 1st Jan 20, 1st Feb 20 and 1st March 20. Here you will see that whether it's a cash transaction or a bank transaction, paid by cash or bank transfer or bank check, all the transactions are recorded on the debit side. If you remember the rules of debit and credit, the rule says for expenses you need to debit the expenses and you credit the incomes. We know that rent is an expense here. So what we have done, whatever amount we have paid during different dates, all the accounts have been debited here. So the total of this would be transferred to something called as the profit and loss account or the income statement. Why? Because we know that expenses and income for a particular period needs to be closed down, are required to be closed by transferring them to profit and loss account or the income statement. whereas the capital account, assets account, liabilities account are not closed, but they are transferred or carried forward to the next year. So in this way, we would say that ledger account is a place where transactions related to any of the five categories, be it the personal account or account related to an individual, account related to income, account related to expense, capital or liabilities. Assets, liabilities, capital, income and expenditure. Any transaction related to all these five are recorded at a place where only transactions or only entries related to that particular account are recorded. Why do we need to prepare the ledger account? So that we have a summary, so that we have a place wherein we can find out as to how many transactions have happened. Because if you remember, in journal what we do is we record that on daily basis. So if I want to know how much amount has been paid on account of rent, say for example in this particular case, what I need to do is I need to keep on looking through that journal for the whole year, and I need to identify as to where I have paid this, on what date I have paid this rent. Then I need to do the totaling. I need to total all these transactions. Then I'll find out as to how much rent has been paid in a particular year if I do not have a ledger account. But if I have a ledger account, what I can do is at the end of that ledger account, I will find out as to how much amount has been paid towards rent, and I will transfer this to the income statement, because we have seen ledger is a place from where the transactions or the amounts or the entries, the closing balances are taken to the financial statements, which are the profit and loss account, which is the balance sheet, and the cash flow statement. So the amount of a ledger account can directly be taken for preparation of the financial statements. Hope this ledger account, the way how it is prepared, is clear to you. I would request you to do at least 2 to 3 illustrations so that you have a better idea of how to prepare a ledger account, right? Thank you.